Welcome to Empire State of Wealth, the podcast dedicated to helping you invest in the dynamic and lucrative New York City real estate market. I'm your host, Joshua Luberisse, and today we're diving into the fundamentals of real estate investing. New York City offers a diverse array of opportunities for investors, from residential properties to commercial buildings and everything in between. But before putting your money into any deals, it's crucial to understand the basics. In this episode, we'll explore the main types of real estate investments, property ownership structures, financing options, and how to evaluate deals based on cash flow and appreciation. By the end, you'll have a solid foundation to begin your real estate investing journey in the Big Apple. Let's start by looking at the four main types of real estate you can invest in. Residential real estate includes single-family homes, condos, and multifamily properties like duplexes and apartment buildings. These are properties where people live and they provide rental income and the potential for appreciation. On the commercial side, you have office buildings, retail space, industrial warehouses, and even hotels. These properties are leased to businesses and can offer higher cash flow, but may also be more management intensive. Mixed-use buildings are a combination of residential and commercial, like a building with apartments above and retail stores on the ground floor. These can be attractive because of the diversified income streams. Finally, real estate investment trusts, or REITs, allow you to invest in a portfolio of properties passively, similar to buying stocks. Next, let's talk about how to take title to a property and finance your investments. The simplest ownership structure is sole ownership, where you own the property in your individual name. Alternatively, you can own a property with partners as joint tenants or tenants in common. Many investors choose to hold properties in a limited liability company or LLC for asset protection and tax benefits. Corporations are another option, though less common for smaller investors. When it comes to financing your investments, you have several options. Conventional mortgages are available from banks, with down payments as low as 20-25% for investment properties. FHA loans allow for lower down payments but are only for properties you intend to live in yourself. Private money lenders and hard money loans can provide short-term financing for flips and rehabs, though at higher interest rates. Owner financing is another creative option, where the seller agrees to finance all or part of the purchase price. With ownership and financing squared away, let's move on to analyzing deals and properties. One of the most important factors is the location. You want to invest in neighborhoods that are growing and appreciating in value. Look for areas with strong employment, good schools, low crime, and amenities like parks, restaurants, and shopping. To evaluate the financial performance of a rental property, you'll calculate the expected monthly cash flow and annual return on investment. Start with the gross rental income, then subtract out all operating expenses like mortgage payments, property taxes, insurance, maintenance, property management fees, and an allowance for vacancies. What's left is your net cash flow. Cap rates and cash-on-cash returns are two common metrics used to compare properties. The cap rate is the net operating income divided by the purchase price. Cash-on-cash looks at the annual pre-tax cash flow divided by the actual cash invested. In general, you want to see cap rates and cash-on-cash returns of at least 5 to 10% for a solid investment. As you start to invest, you'll need to decide on your overall strategy. Are you looking for steady cash flow, long-term appreciation, or a mix of both? Investors focused on cash flow often use a buy and hold approach, purchasing rental properties to hold for the long term. Flipping properties for a quick profit in a rising market, can produce strong returns but also comes with more risk. Using leverage in the form of mortgages allows you to buy more properties with less of your own cash. However, be conservative in your use of debt and always maintain cash reserves to cover unexpected repairs or vacancies. House hacking is a great way to get started by buying a small multi-unit property, living in one unit and renting out the others. The rental income often covers the mortgage and you live for free. As you grow your portfolio, building a team becomes crucial. Partner with an experienced real estate agent who understands investment properties. Develop relationships with mortgage brokers, attorneys, accountants, and contractors. A good team will save you time, money, and headaches as you buy more properties. We covered a lot of ground in this episode, but you now have a solid grasp on the fundamentals of real estate investing. We explored the different types of properties you can buy, how to own and finance them, and how to analyze cash flow and appreciation. You learned some of the key strategies used by successful investors and the importance of building a team. If you're feeling inspired to take action, start educating yourself further. Read books, listen to podcasts, and network with other investors. Begin analyzing deals in your target neighborhoods and run the numbers. Before long, you'll be ready to make offers and close on your first property.
In future episodes, we'll dive deeper into each of these topics, bringing you expert insights and case studies from the New York City market. Be sure to subscribe so you don't miss an episode. Until then, I'm Josh Luberisse signing off. Here's to your success in the Empire State of Wealth.